SpaceX stock is down for a sixth straight day, now trading roughly 45% below its all-time high, just weeks after its record-breaking IPO. In dollar terms, that's about $1 trillion in market cap wiped out from the peak. And here's what makes this different from a normal stock crash. Nearly 30% of the shares in this IPO went directly to retail traders. That means this isn't just institutions taking a hit. It's an enormous number of everyday investors watching their very first SpaceX position bleed red week after week. There was a brief spark today. The stock popped mid-session after reports that SpaceX is in talks to supply computing power to the Pentagon, but it faded, and shares closed the day near their lows. So the real question isn't whether SpaceX is a good company. Nobody's arguing that. The question is whether this stock was simply priced for perfection at IPO and is now being valued more honestly, or whether this is a shakeout before the real move higher. Back in February, when SpaceX completed its acquisition of xAI, the combined entity was being valued at well over $1 trillion, with xAI alone pegged at roughly $250 billion of that. But by the time the IPO actually priced, the whole company came at a $1.75 trillion valuation. If you add up what the individual pieces were worth just months earlier, Starlink, the launch business, and xAI, you land somewhere closer to $900 billion or less. That's a gap of roughly $800 billion between the sum of the parts and what investors paid at IPO. That's not a small rounding error. That's the entire debate in one number. If the market was effectively paying for hype around AI valuations, the same wave that's had people questioning Anthropic and OpenAI's private marks, then SpaceX's IPO price may never have reflected the underlying businesses at all. It reflected the mood of the moment. That's also why one long-term holder can look at this stock and still call it expensive, even down 45% from the high. Expensive isn't just about the percentage decline, it's about how far the current price still sits above what the parts are actually worth. And on the other side, you've got investors treating this decline as an entry point specifically because the market hasn't had time to properly price Starship, the satellite permit stockpile, or the Pentagon computing angle yet. Pieces of the business that simply didn't exist as public, analyzable line items a month ago. Let's ground this in the actual numbers. The stock priced at $135 for the IPO, opened at $150, and briefly traded as high as $225.64 before this slide began. Strip away the pop and the froth, and the stock sitting around $122 to $124 today is roughly 8 to 10% below the actual IPO price. Not the hyped-up open, the real allocation price that early investors paid. That's the number long-term holders are anchoring to, and it's why some of them aren't panicking. They didn't get in at $225. They got a small allocation at $135, and by their math, this is closer to a discount than a disaster. But the bear case has real teeth too. Short sellers have been piling in aggressively. Bearish positioning has ballooned from an estimated 40 million shares just 3 weeks ago to around 185 million shares now, close to 29% of the entire publicly tradable float, representing roughly $25 billion in bets against the stock. That kind of shift doesn't happen because of one bad headline. It happens when professional money believes the structural setup, including a looming lockup schedule, favors more downside before it favors upside. And that lockup schedule matters a lot here. SpaceX's IPO only released about 5% of its roughly 13 billion total shares outstanding. The rest is still locked up. KeyBank estimates the first major unlock lands around the company's Q2 earnings report, potentially freeing up about 11% of outstanding shares, with additional 4% tranches following on a set schedule tied to performance milestones. In plain terms, even if the Pentagon deal firms up and Starship starts executing cleanly, there's a wave of new sellable stock about to hit the market regardless. That's part of why some traders are comfortable buying pieces of this decline without calling it cheap. On the fundamental side, the business itself hasn't cracked. Starlink remains the profit engine, around $11.4 billion in 2025 revenue, $4.4 billion in operating profit, a 63% adjusted EBITDA margin, and more than 10 million subscribers across over 160 countries. The space segment, which covers third-party launches, is smaller and slower, about $4.1 billion in 2025, up just 8% year-over-year, and mostly Pentagon and NASA-driven. That Pentagon computing power report that moved the stock today would sit on top of that existing government relationship, not replace it, which is exactly why it caught the market's attention mid-session. On valuation, even after this crash, SpaceX isn't conventionally cheap. The stock still trades at somewhere around 50 times base case 2026 revenue estimates, and the price-to-sales ratio sits in the high 20s on a trailing basis and above 50 times on a forward basis. Wall Street's own targets reflect just how unresolved this is. Goldman Sachs set its target at $205. Morgan Stanley came in far higher at $300, a gap of more than $1 trillion in implied value between the two lead underwriters. Average targets across all analysts sit around $240, but the full range runs from a low of $62 to a high of $800. When professional coverage disagrees by that much, it tells you the market genuinely doesn't have enough data yet, and that data starts arriving at SpaceX's first public earnings report on September 2nd, when the underwriting bank's quiet period lifts and coverage likely expands well beyond the handful of analysts following it today. So where does that leave things? This isn't a broken business trading at a broken price. It's a business the market never got to properly value before pricing it at $1.75 trillion, and it's now getting priced in real time, in public, with retail investors holding a meaningful chunk of the float along for the ride. The Pentagon computing angle, the XAI integration, and Starship's trajectory are all genuine value drivers still being worked out. But the valuation gap between the IPO price and what the underlying parts were worth months earlier hasn't fully closed, and the lockup wave hasn't even started yet. That combination is why even people who still believe in the technology aren't calling this stock cheap. They're calling it unresolved, and unresolved stocks can go either way fast. If you're watching this position, September 2nd is the date that matters most. That's when the guesswork stops and the actual numbers start coming in. Let me know in the comments. Are you buying this pullback or waiting for the lockup unlock before touching it? And don't forget to subscribe for the next earnings breakdown.